comes to bank your business, records that we present agrees, and they can understand it and interpret it simply. So they are standard about preparation of accounting. Really, for instance, in accounting records and preparing the financial statements, some foundational principles are agreed upon. So accounting principles are based on certain concepts, conventions, and traditions. And in broad terms, we divide them into accounting concepts and accounting conventions. They are both principles. When I say principle conventions, so basically, this is what guides preparation and presentation of accounting in each institution, across institutions globally. So generally accepted concepts and principles. So the primary objective of these principles is to, one, eliminate or reduce subjectivity in judgment presentations and value measurements. Before the IFRS came up, the way this country has their own way accounting concepts and the way they adopt and way they do their things. It makes it challenging for cross-border investments. And many people that are aware of 2001, Enron, collapse and institutions or the way things run that time, the management can just prepare accounts to one way or the other, or accounting engineering and all this nonsense that people are doing. It didn't allow people to be open-minded and be able to be brought out. PwC, I've not been able to understand of these days before they came back again. They affected them. As this someone put that one, the audit firm, we looked at it in late 1920, 2000. I tell you, some of these things are happening towards Savannah Bank and remember that Savannah Bank of these days, before he died, I was not good because of it. We declared the accounts, said the management, they do all these things. So what happened to Savannah Bank was not saying to some of what they were auditing. Some of these things are the one thing that we know that people have known that well, Savannah Bank that all those things happen to Savannah Bank, the auditors are not indicted because what we were preparing the account that we need today. So all those games you are playing. So these are things that happen. So that's why companies and industries and countries before they came back there. So there is something called accounting principles concepts. So just to eliminate subjectivity in judgment and presentation of measurement. It's also important to have uniformity and comparability between different organizations. So the underlying basis of acceptability of these principles, that is the concepts and the convention, is objectivity, reliability, practical stability, visibility in terms of cost effectiveness, and easy comprehensibility. You show objectivity. Don't just say that you're objective. It's seen to be objective. Don't just say in our organization we are objective. We should be seen to be objective. People that see your record don't need to tell me. And it's at the to perceive that you are objective. So that's why these principles are there. Don't tell me that you are reliable. You should be seen to be reliable. The way your record is prepared. That's what we have seen. Then everyone should be practical and be able to be to use the record and for easy comprehension. So what's accounting concepts? We have about 9. Universally accepted. Accounting concepts refers to basic assumptions. Basic assumptions, rules, and principles, which work as the basis for recording business transactions and preparing an account. These are the before we just as a have their own accounting body and regulatory rule. But now it's internationally IFRS. But let's start see that when there are conflicts in some concepts, the one that is industry specific, you have to apply for it. So business entity concepts. These are two that enterprise and owners are two separate independent entities. That is, business unit is treated as a separate entity for its owners. Measurement concept. All business transactions are monetary plans. That is, money as a common denominator by which economic act. Now, see that thing I highlighted in blue. I saw it in your material, but it's not correct. It's not true. Are you getting it? And we know that MCP, they prepare your material, but that statement that not these people are copy from the material, non-financial assets and non-part of an accounting record, even where they are known to have some feedback. It's not, that's why I put that IFRS there. That as an intangible asset, intangible asset, IS 38 and IS 39. That measurement. So I don't know how you want to do, but that statement, I don't know, it's not correct. It's not true. Yes. That's why I put that in the IFRS. That statement I saw it covered in your material, and that statement is not correct. You have to tell you what who do it. Copyright, the assets. Are you getting me?
Yes, sir.
Copyright is an asset. Google is an asset. Intellectual property is an asset. Are you getting me?
Yes, sir.
And it can be mentioned and put in your accounting record. That's an asset. Are you getting me?
Yes, sir.
So that statement is not, but that's a feeling that I will tell you. So I don't know how you come to about it like that. God will you don't want to answer. Praise the Lord. So, but if you see option there, no outwise. So that's why I try to put that to correct. That statement is not correct. Then going concern concept assumes that the MFP will continue as no going concern. Not that. That is assumption that the business will have a very long life. It's an assumption. And that's what guides expiration of record. Periodicity concepts that records are divided into periods. You have weekly, monthly, that's how the management account is very on monthly basis. Historical price, not so how much what revenue should be recognized only when it has been earned and realized. Revenue is recognized on floor head in the period which is earned irrespective of the part. Your irrespective of the part, whether it is C or not. Move that way. And you can recognize all the expenses and payable, but what job comes
Hello. Tunde, please can you confirm that you can hear now?
Yes, sir. I can hear now, sir.
Thank you. Concepts. Matching, that's you match your expenses of the revenue. All revenue and during an accounting year, whether receive or not. Just as say accrual or the that you don't carry the income of year 2025 and bring it in into year 2024 and say that you because you see any no, you must match the expenses of the yeah, everything was thrown together. The issue of dual aspect concepts, which is common debit and credits, right and left, front and back, everything is this or this. That's how God made the world. You are either alive or you are dead. Are you getting me? Yes, sir. So that's dual concepts. Either you are dead or you are alive. Either you are a debit or you are a credit. Either you are a liability, you are an asset. Are you getting me? Yes, sir. That's how life is. So that's dual. So it's giving and taking. Then we have convention. All those nine things we said are concepts. You have convention. That's the principles how things are recorded or reports. When these principles that you have adopted this principle, there's some more that's optional. Whether you believe we accept this, okay, we leave this one, although correct. This is how we want to use this record. Are we together? Yes, sir. You are okay. The principle say we can use this method, we can use this method, we can use this method. Oh, now okay, we adopt we using this one. So convention is not telling you that since you have adopted to be using this one, you must what be consistent in using it. Year in, year out. Are we together? Yes, sir. Before we get say that consistency, disclosure, materiality, conservatism. Are we together? So this work of convention, so as a common practice, which are universally followed in recording and presenting accounting information of the business entity, it helps in comparative, and I see why I underline some things I should note that if you say it's a common practice used by business entity, used for comparative analysis. Let's see one by one. Consistency convention is the bank's adopted policies and practices, the one that you adopt as an organization for how your financial statement is prepared year after year. Consistency now should be within the organization. That means vertical consistency. What you 2023, 2024, 2025, 2026, bring the financial, it should be able to be consistent the way you prepare so that you can compare it. Are you getting me? Across timeline, that's horizontal consistency. Then between organization, we have a which is say Microfinance Bank. We have which one is it? Cross Bank. I mean, we have other. We should be the records and compare it across organization. Full disclosure is talking about relevant facts are displayed and adequately stated in your financial statements. All material facts that are necessary, that are relevant, must be stated. All assumptions that you made, all estimates, all methods that you apply, you must disclose it in your financial statement. Materiality convention holds that issue of nature, what is material, what's material to you and what's not material. That's why it's the issue of disclosure and materiality, they flow together. Are you getting me? Because you can say that 50,000 is not material for us. But a unit microfinance bank or that, because you can there's some loan that you are disbursing now. It's very threatening. Are you getting me? If a unit microfinance bank tries to do one loan that you are disbursing alone is their own capital base. Are we together? Yes. So you can afford to say 1 million naira doesn't matter to you. But you go and carry 100,000 naira in microfinance, other microfinance, then go cry. Are we together? Yes. You can buy something and say that this one you can write it off. You can write it off for expenses. It's not material to us. So you can capitalize it and say, I bet make you spread down for 2 years for us. So this is why issue of materiality convention comes in. This must be disclosed. And whatsoever is already stated that it's material. Okay. The issue of conservatism. This one has something to do with related to do with prudence that we talk about. This convention is based on anticipate no profits, but provide for all possible losses. That's conservatism. It provides guidance for recording transactions in the future. Anticipate all. That's what I talk under prudence. I talk about provision losses. You say, we are giving this loan, we are going to so this. I think we'll talk about it later. That time has gone. So comparing the two, when you say convention and concept versus two key things that differentiate them, we want to talk about it. There are two things. Number one, why concepts are applied mostly in recording transactions. Conventions majorly apply preparation and presentation in financial statements. Hello, why you are talking about okay, this is we are going to apply this, how to apply it in when we record the transaction, or how that thing is now prepared and presented is what convention is talking about. Hello, are we together? Yes, sir. Convention involved from practice by accountants. Concepts are usually set by accounting bodies. So that's why I told you convention. I say practice. Are you getting me? The way you are doing your things is what convention is talking about. But the standard that is set that you adopt in preparing that thing, in that practice, concept is talking about how that is set. So that's just basic thing. Are we together? Then you have accounting record. This is just right. Accounting records. In preparing your records, financial statement, all these things. We have record that's bottom line. The children that give back, what you use are the servants that will come and work for the main organ. All the financial statement, you want to prepare records, you want to prepare, you are talking about this. These are the fundamental things that help you in the recording. Talk about chart, you have chart of accounts, I mean list of your accounts. Different accounts used, different accounting organization, you list them. If you go to Bank One, you see chart of accounts. You list all the accounts in the system, the number attached to them, the code. So chart of account carry a code that you use. Then we have general ledger. That come as a group, make a group of transactions that are similar, that are related, to come together. So that's general ledger is a collection of the group of accounts that supports the attention in the major financial statements. So you post transaction from cash book and others. So accounting journals, I think I should have even put chart of account, accounting journal, and general ledger, so that it's further. Because accounting journals are the small things that you record, then you have consolidate them and put them in your GL for each heading. So accounting journals are the book of original entry. That's that small paper you carry along that you put that voucher, you fill, you carry from one table to the other. Those are journals. So when you take it to account you use it. You say, okay, this one belongs to this group. They will post it to the GL. Are you getting me? But ordinarily, each of them come together. So that's what we are talking about. Now, financial statements on the GL journal, we prepare financial statement. There's something to find myself. I don't think I so class we are settled. Please, can I get something to find myself? Oh, thank you. Accounting records. Accounting record is not complete until it is presented. The GL, the accounting journals, the chart of accounts, they are not complete until they are what? Presented in what is called financial statements. That's what people want to see. All those other things we are talking about, the concept you adopt, and the convention you use, and the accounting journal, and the accounting GL, all those things, they are your organization. When all these things we are talking about come into I can't. So all this grammar we are knowing about, nobody will see them. Are you getting me? And it should be stores. It should do this one. Nobody. They are just what the this thing. All this grammar we are blowing is what we call financial statements. All those grammar we are blowing, where they will reflect is what we call financial statements. Are we together? All those other things we are talking about now, there's something called management accounts, financial account, but what we call financial statement is what we prepare. Management account, we prepare financial statement. She's managing what, and that's a other financial accounts. And you prepare for the other, we call it for the other society. But everything is still financial statement. Management account, we prepare financial statement and other all the way. So all this we are blowing, talking about. So then the final destination is what of financial statement. That is what we show you outside. That's what we can carry and compare one to another. All the grammar we are talking about. So we have our 4 key financial statements. Number 1, statement of comprehensive income. That's income statements, or some call it profit or loss accounts. Number 2 is what we call balance sheets, statement of financial position. Number 3 is cash flow statements. Number 4, which is the new bride that came in a few years ago, we call statement of changes in equity. Before now, it was that first 3, but it's of recent that this last one came in. And what statement of changes of equity is talking about is similar to what cash flow statement is talking about. This one just came in, say, okay, we want to see changes in the equity of the owners. As we are talking about, this is how cashes move. This is how we get our cash, how cash go out, this is how cash. Okay, the equity of the owners, let's see how changes comes. Then you should present it. let people see it, and let's all be able to compare it year to year. That's basically. Let's see the narration. Let's go down. It shows the summary. I think I've taken too much time on this slide. Okay, let me quickly go. It's balance sheets. I think we all know this balance sheet now. So I need to talk about it. I should talk about it. I'm just looking at it. The first class is not enough. Okay, except for the mass com student, I should say it. Balance sheet state, that's statement of financial position. This shows a summary of position of your accounts at a particular time or date. It must specify when you have balance sheets. You don't use the word as at. I think now the objective that you are doing is that you're going to prepare, because all of the things that make accounting students or people that prepare is when that heading is very, very important. It's part of it. This one as at. Let us know which dates we're talking about, because that's where we want to compare it. We want to say as at 31st August 2025. You should also know when you are comparing to another person, you compare at that time to that organization at that date, or you are comparing it to our previous year, 5 years ago. Saying we want to see consistency as we talk about. We want to. So it's very important to say as at. Are we together? Yes. So balance sheet is talking about standing is a financial position where now they occupy now. The position where now occupy as at this date. We want to see it. So this statement shows the assets, liabilities, and equity of the owners. So that's the equation. The normal equation: asset is equal to liability plus equity. So we use common language over the years before them born us, before them born me. Now balance sheet and the column. But recently we are still calling balance sheet anyway, because we are used to it. But common language now is statement of financial position. That's the common language. That's IFRS language. So if you go for interview and you brag, and they're talking about, remember to mention is if you want to present yourself, you go and you also balance sheet. You are balance sheet. They will look like say you interview. You call yourself an accountant. Are you getting it? You should use the language. Are we together? Display of financial position. Example. These are example of balance sheet item formats. We have cash and due from banks. Thanks. What is the banks? Because for balance sheet of the financial institution is prepared in order of liquidity. The most liquid come first compared to others. When you come to manufacturing, you can start from fixed assets. But when you come to balance sheet of a financial institution, you start from the most liquid. And what's the most liquid in financial institution? Cash. Abi? That's the most liquid, and that's the most. Even the politician, if they want steal money, they will ask you to transfer, give me cash. Could he? Abi? Yes. So that's the most. I'm robbery. If they want now, they want to money them. But if anything they change now, they may, if there's a way with this online transfer. Abi? You see, so that's the most liquid. Then you have your loan. You have your loan, short-term assets, long-term assets. I just sit here. You will see it. Then we have balance sheet and liability. Then we have liabilities. Liabilities are deposits that you get from customers. No be you now. You are using it for business. So it's a liability on your part. You have your time deposits. You have your payables, your credits. Short-term, no payable. Other short-term liability You have other long-term liabilities. You have your equity, that's the money of the owners, and your reserves, your profits. Then for organizations and microfinance that have donations and grants, they are out there. Then the second financial statement is income statement. Yeah, you have the income statement. That's the profit or loss account. This one records income earned and expenses incurred. As I told you, the financial and balance sheets, as that this one is for the year ended or for the period ended. Each a week for the period ended. When the account department is prepared for management weekly meeting that the account department prepare, they will tell you just week. They will tell the management as that last week Thursday, as that for the period ended this date on the Thursday. That's what, if they want to present last week, they will give a specific date. I'll tell you from this period to this period of 1 week, this is what we then they will compare to the previous week. Are you getting it?
Yes, sir.
So the language you use here is for the period ended or for the year ended. If it's a year, or mostly for the period ended. But if it's for the financial statement that is final annual, it's for the year ended. I believe you are together.
Yes, sir.
So the IFRS language for this is what? Statement of comprehensive income. This is its interest and fee, income from other related activities. Just state your income. You list it here. Then other operating income. Then we have expenses. You list all the expenses together. You pay. That's it. Then we have cash flow statement. Cash flow statement is basically to tell you about cash movement, how cash came in and how cash go out in the year. And it's finally 3 sections: operating, investing, and financing. Thank you for yes, I will share with you. So I should just give it my go.
Yes,
Yeah.
sir.
It's very good.
I just need to say we are team.
Okay, I will do that. I know that it will help you. Let me end this one. There are about 6 presentations. All right. There is statement of change of equity. Hello, please let me. This statement also shows equity statements. Sorry, it's also known as equity statements. I told you, it's just to tell you about what was the equity changes in equity. Just as you have cash statements, talk about the movement of cash, how cash came in, how cash went out, the one that went to investment, the one that went to operation, the one that went to financing. So this also is telling you how. So why balance sheet shows company equity at a single point in time. The statement of change of equity provides a detailed breakdown of transactions and events that explain the change in equity from one balance sheet to the next. So you have at the beginning and at the end. The balance sheets, the equity stated at the end of 2023, equity at the end of 2024. You want to see the movement, how you have one that go to reserve and all that. So all these changes are things that we want that go to reserve, we want that maybe there were losses and provision rates, how reserve we want that there are special reserves. All this is what we stated here. Then aside from that financial statement, which is a common in microfinance industry, we have this statement record, what we call loan portfolio reports. Are we together?
Yes, sir.
The four I listed, they are common to all industry. Are we together? But now this one, portfolio report, is from microfinance industry. Even a commercial bank, guys, they don't know a commercial bank. I'm telling you. Some things that you, your marketer and all these things, something you know as a branch manager, go to commercial bank, go and ask them, you know, what you don't know their capacity. They only know this thing when you begin to defend some of these things. So don't see yourself as a minor to somebody. It's only the way they know they give you microfinance. You get more experience than this commercial bank. I've been between those, and I've been more than enough in this industry. Now, so all right. So that's the challenge. God will help us. God will take it here. That's why you see our guys, if you want to move commercial bank to read, they begin to shine. If you move to commercial bank, you see the way you be shine. Because of this. So that's why as much as you are in this section, take time and learn. Don't let your mind be or maybe learn first. Grab the best you can grab from here. You see how you be shining when you get there. Look at our guys that have moved there. I have more than enough staff that have moved to this industry. You go to shine. Even as a compliance officer, you see the way they go to shine. So loan portfolio reports. This one is just for the microfinance because you can read it in your material. Babe. Thank you. That's for this. Let's go. No, it's only this slide though. I have other. Not that I cannot share. Let me do another one, then I will stop. This one is important. Eh? The one I first share, that one is common. You can see beat sleeping. Yes. Because it's an accountant. All these things that they do. You don't concern her. She sabi and pass everything. Eh? But I suppose give her, make she don't teach herself. So that's why I know when I see her sleeping, I know if I go myself. Because I know she sabi and pass. All right, financial analysis. When you have financial statements, don't be there, stop. It's not really relevant. You have that record. What does it mean? You should be able to analyze it. That financial statement we talk about all these assets and balance sheet, all these things. And what do they mean? You want me to bring my money to invest? What do they mean? That thing needs to be analyzed. This is very, very important. So financial statement provide valuable information to organization, blah, 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 or globally. So let me just skip this. Before this grammar, so what's financial analysis? According to CCAP, computation of adequate ratios from financial statement and interpretation of these ratios to determine their trends. I copied this from your material. Are you getting me?
Yes, sir.
So go and read it. We have ratio analysis. Ratio analysis is a financial management tool that enables managers to assess their progress. So it helps you on this. If you read this material, it will help you. I will give you so that I can go and read it as you ask me. I've done all the So ratio analysis is in 4 specific, according to Z gap, 4 specific area. A group. This is classification. And according to the purpose that they serve. And that's why they are in this grouping. See, this is your calabash house. Now every day they get just like they must have something to do in every day. Just like Ilefe. You know Ilefe. That's why they say that's the origin of to buy all this Ilefe. There is no single day we don't do visual correction. You have 365 days. That 365 days, one day, they must do one sacrifice. They must do one ritual in one day in Ilefe. That's why they call it. So all those kings, all of them, they have their own. They sacrifice that each of them, they must do one in Ilefe. So just like Calabasa, they must do party. They must do something. Anytime I come to this Calabasa, you will hear something. You know the effect. You hear something. All right, there are 4 groups. You have the sustainability, profitability ratios, which is very, very vital. Every one of them, efficiency and productivity, asset liability, and then profit and portfolio quality. What is financial sustainability? I just help you to. I just give you that equation, and you have to put it there. It's talking about ability to cover all your expenses. It's good that you're making profit, but more importantly, liquidity is more important. Hello? Don't just be dancing that you're making profit. Our profit is growing. How liquid are you? How sustainable are you? All those loans you have given out, if anything happens to you suddenly, are you sustainable? Are you liquid? Do you have sufficient funds to stand long? This is where error banks make when they are making profits. And that's why you see banks that are making profit, they just start shutting down when there's rush on them. This is where sustainability is key in a financial institution. Branch managers, operation managers, this is what you need. Don't just put your eye on the profits you are making. Put your eye on, am I liquid? That's why you see the management shouting on deposit mobilization. It's very vital. Hello? Because there are some things you cannot do with deposit. There are some things that we learn, we see it here. Prudential guideline is very, very important. So what is financial sustainability? Sustainability of financial institutions represents the ability or capacity of such bank to cover all these administrative wire costs from the operating income, including the provision need for loan loss. Hello? That's where your credit disbursement comes in. Hello? What is your part? Inflation, the cost of funds deployed into business, and the capitalization for goods. Because there are some standard provisions you must know that is required by CBN. This one, you make this profit, this percentage must be provided for. This percentage must go to this reserve. When your capital is at this level. We'll see this later. So, cram that, so sustainability is coverage of financial expenses, that's cost of funds plus inflation. I give it, the formula is here. When we come to next class, I told you we'll do all the calculations. Just formula, and we can practice before then. Just check this formula. I just give it to you. That red one just show it. So I just use the red thing to show it. Because that's profitability and social impact. And so then sustainability profit ratios. These are the ratios, or the ratios under sustainability and profitability ratios. I mean, group rather. We have the operating self-sufficiency. That's the formula there. Financial self-sufficiency, return on asset, return on equity, profit margin. I try to highlight for you so you won't you see the one I use blue, so that you won't make mistake. Return on asset, you see profit after tax parts, profit after tax. But when you come to profit margin, it's put before what? So that make I not go make that mistake. That's why I try to do this analysis and prepare for you. Then this step, you see when I say operating financial revenue divided by operating expenses. So that line that slash you are seeing is the line that's supposed to be on that. Are we together? Eh? Yes. So the other one, operating expenses plus loan loss expenses plus financial expenses, that's the denominator. Only financial revenue is the numerator. Numerator rather. Eh? Are we together? I hope I'm blowing the right grammar. Eh? So I'm just saying because you have to start, you see the so that you make me you think that it's minus or you group it together. Remember you see like this, that's why I put red this is divided by. So the only numerator is financial revenue. The other one say operating expenses plus loan loss expenses plus financial expenses is denominator. The same thing financial self-sufficiency. For financial self-sufficiency, we say it's adjusted operating expenses, adjusted loan loss, adjustment financial expenses. I think I will. Okay, next one. You see how that adjustment is made. Eh? That's a formula for adjustment. Before you can use them.
So get the formula before we use the apply.
So return on assets, that's it. What's that?
I think don't take care.
That's what see. That I took time for this financial so that you guys don't make mistakes. People fail it, but I took time to go to your material and prepare this thing for you. You take this, you're okay. Because there are some, see, there are some I have noticed in your material, there are some the way they put the formula, it will be confusing for you. There are some they even make mistake. Hello, there are some I saw that they wrote something and the formula they put on that is wrong. Right. I've looked I tried to do I don't know why some of these there are some of these things that should not be. There's some I see that the formulas they put it and the formula under it is wrong.
So in that sense, your service
The formula they put under it is wrong. That's one or two I saw that the formula they put under it is wrong. All right. Financial revenue. I've tried to explain it. Go and read it. So hello, gist. Financial, I think financial self-sufficiency. This is adjustment. Are you getting it? So to adjust that, I said adjusted operating expenses to adjusted formula. So that's the formula. Adjusted financial expenses. You have inflation adjustment plus subsidized cost of fund adjustment. So what is inflation adjustment? Inflation adjustment has formula. So when you calculate inflation adjustment, you calculate subsidize this thing. You now add it together. That's adjustment financial expenses. So that's the formula you do for the adjustments. As I explained to you, the plus sign. So just take your time to look at it. The second ratio, guys, please let's be together, please. Asset liability management ratio. Asset liability management ratio. This is the ratios under that. 1 to 6 is the one that is expected from you. I just added the other one. That one I draw my own journal in case it comes. 1, 2, 3, 4, 5, 6. Now that one expected for you. Like that one sitting in your material. So these other three, me I just added because some of these people they are young people. You can just go and ask some question that I don't know why. I don't know what I think now they say it's your OBJ that you are doing. It's OBJ.
I'm telling you.
I bet make I delete this one. You know it?
No, leave it here.
Disability.
I will delete it. I will delete it. You have more than enough to read.
Disability.
You have more than enough to read. Don't confuse yourself. I will do it. Don't worry. I will, of course, I will.
Leave this one.
I've told you now. I've told you that because there's some things I've seen that it will really help you. Not just want. Because you say you want to. I've tried to look at your material and try this to make it easy for you for the exam.
Thank you, sir.
Because if you carry the book, the leader, and the end up confused. And this financial analysis. So you need to read. And by the time you read material, it's too. I try to get so that it's easy for you to read and grab as far as the exam. Because it's so close for so many of us. I think it's next month. It's not that they say, that's so it is.
This month.
I encourage you to write the exam, please. Have the certificate. The way the industry is, you need it too. And it's not only here in microfinance alone. If you go to commercial bank, they are having sections now. Are you getting me? They are having, you will need this certificate anywhere. And when you have MCP, you are already member of CIBN. So that fixed asset people are happy to CIBN, but if people don't want to go and write the other exam. But you know, when you register, my CIBN number that for CIBN now, or normal CIBN is what I use for it. When you register, it's the same number. That's why you look at a number now, old number. I registered since 2008. You go the right. CIBN started lamenting that. Why is it that most people, especially their former president, or Okafo, see why is it that most bankers they go and writing this one, they will not write that. Now make it compulsory that if you are a staff of the bank, you must register with CIBN. Whether you are chartered or you are not chartered, just register with your number. So the compulsory for us then to register. So everybody register and you have to send your name and your number to resources department. So that was 2007 or 8, you have to in those days you have to register. It's compulsory. So when I came to Microfinance, I think you should go and write MCP. I know MCP, whether you are a chartered banker or not chartered banker, you must still write MCP. You are working Microfinance. It's compulsory. Are we together? You can't, if you carry your mentality of commercial bank, come and work in microfinance bank, go mess up. Are you getting me? There are some things in microfinance bank, you carry the mentality of commercial bank and come and work here. You mess up. I've seen the two words. But you can carry your mentality from here to commercial. So that you are in a better position. I'll tell you the truth. Old. What do you mean by you don't old?
I'm not 24 anymore. I have 4 years experience.
Those things are not. All right, let's move ahead. Efficiency, productivity ratio. This is the third one. I've given you the formulas here. Operating expense ratio is also called efficiency ratio. Are we together? That's why I see me put red under it there. In case you ask, you can say, what is the operating expense ratio? The same language I use for efficiency ratio. So if you use the two, any of those languages, that's talking of the same thing and the same formula. Are we together?
Sorry, this loan portfolio value.
Loan?
Over
Number of loan officers.
orders.
Loan officer now.
Loan orders.
Which one is loan orders?
It's not seeing. The thing is,
Loan officer, there's no loan order here.
I'm not seeing clearly. The thing is tight.
Loan portfolio value. That is the formula. Loan portfolio value. That is number of loan orders.
Which one are you talking?
It's tiny. It's not seeing clearly. Please come closer.
All right, okay. So these are the calculations needed under this ratio. The formulas are there. Maybe when you come next class, I will just that's as I thought. I just want to rush through this so that next class, the only thing we come and do is look at the samples and that. So by that time you cram the formula. You have practiced it on your own somehow. There may not be need for that. The reason is that the next time they put for me is like a 2 days you exam.
And that's good.
You understand? So that's why it's just like that. The only one I can pass is this. So that's why I put myself to come. I will have given you another excuse that maybe keep this class. But I know that you need it. So these are the formulas and ratios needed under this group. Then portfolio quality. Portfolio quality. Number one, which is very, very important, and the lion's share under this portfolio quality is what we call PAR. The language, if you go to commercial bank, go and ask the commercial marketer, what is your PAR? What is PAR? They won't know it. Hello. That's what I'm telling you that you are better off. Go and ask all those marketers that they people they carry shoulder. They don't know what is PAR. Ask them what is PAR. Go and challenge them. They won't know it.
If we then ask them what is fine, they will use money slap us.
Don't let your mentality be like this. You are better off. See, knowledge is power.
Yes.
It's the way you carry yourself. Don't carry yourself with this kind of mentality. See, don't be sad. I'm telling you, don't carry this mentality because you continue like reasoning is bad. When the opportunity comes with the right mentality, you surpass. Get that. So portfolio quality ratios, we have what's called PAR. Some of principal are standing on all past due loans. You can see this one. I say plus this. You can see my slash. So this and plus this is numerator. Are we together? The only denominator is gross loan. Are we together? So that you won't misunderstand this. That's what I'm trying to explain it to you. Then we have what we call write-off ratio, value of loan written off divided by gross loan portfolio. Then we have the arrears too, loan loss reserve and all that. That's the formula. Mind you, all these ratios must work together. You can't use one ratio and say now. One thing about ratio is that not one ratio gives you all the information. You must have all the ratios to explain whatever you want to explain. Are you getting it?
Yes, sir.
That's the sense. You can't say, I have portfolio profitability ratio. You are doing bad. You cannot talk like that. I'm not saying you. I'm talking about anybody that carry financial statement and do analysis. Because it's not only doing the financial analysis, the interpretation. What you call its interpretation also matters. So you must do it, the ratio, and then interpret it. What does it mean? So all these ratios talk about, you must be able when you get to do something. Okay, you have your PAR. Okay, what of the profitability? Are you getting me? PAR, what of the disbursements? So you look at under the sustainability, under the portfolio, you look at those ratios before you make up your mind in the investment decision or whether you should do this or not. So that's this. I say no one ratio tells it all. I think for that we are okay with that. I think I can. Which other one can I give you for now? Is maybe next time. Okay, I will round up with this. There are still source of capital and all that, but others one you can go and read it. Regulatory indicators. Let's go to prudential guideline, regulatory indicators. Banks are highly regulated industry. Highly regulated. Highly regulated. Too much regulation, sir. It is what it should. That's one challenge we have in the banking industry. Too much regulation. But Nigeria, we need them. Hello? We need them. But somehow. But the two key regulators are CBN and NDIC. So the examination, the alternatives. CBN, I say CBN, CBN, sorry. CBN and NDIC. So if CBN, the two of them, the alternative, if CBN come this year, NDIC come this year, and their reports, they change among themselves. So if NDIC come this year, so they will just review the records. That's how they share their examination. But we have other regulators, the CAC, the financial reporting, many of them, they're plenty. I can't list all. Now, let's look at the potential guidelines. Some of the key potential. I don't know whether this is under. I saw it under the material section, but I think other facilitators should take it. I don't know who should take this. I'm doing taking your potential guideline. So I was contemplating on this, but I think I just key ones. Let's look at it. Potential guideline. There are some of these fundamental guidelines that guide in the financial reporting, financial statement analysis, how things are done. Number one is investment in Nigerian treasury bills. It's compulsory investment of minimum of 5% and maximum of 10% of total deposit liabilities in treasury bills. Is compulsory. It must not go below 5%. It must not exceed 5% and 10%. Hello? That's the management every week. You must observe this. You look at it. When you are saying if you want to hide that, loans are getting bad. You are afraid of getting loans. You want to invest it in places, you want to invest it in treasury bills, all those. You have limits of how much of the deposits you can invest in treasury bills. Are you getting it? And when we enter, you have limits of how far you can go. It's compulsory, you must invest. And you can't go below 5% of your deposit mobilized. That's why that money, you can't give it to customer. Hello? You must invest minimum just to guide this system. So every microfinance fund, every minimum of 5%, maximum of what? 10%. So the issue of in a commercial bank, deposit mobilization, they have what we call cash reserve requirements. That means I think it's 50% in my commercial bank, and I think my commercial banks are 16%. So 45% before that they must keep with CBN, that must be in their vaults and CBN that must be in liquid form in case of run or customer rush whatsoever. Are you getting me? They must have their money. Every money, that's why they call them deposit money bank. All those money, that's why giving loan in those places, they have a lot of control about it. And the risk for cash reserve requirement just to control the money in circulation. So that's why CBN, the bring policy out, when it's too much money in circulation, they increase you understand, just to control the money in circulation. That policy, that CRR does not apply to microfinance. The only one that's applied to us is, so that's why you can have so much money. But you need insurance now. You can have money in your vault whatsoever. Because what? You are not directly going to CBN to get money. You go to the commercial correspondent banks. Are we together? Yes. Okay.
So what it means, if they are all the systems, what it means is that they are going to get information also. They are on there.
The commercial bank.
Yes.
That's why I'm saying that it doesn't have their own work. That's why you see that loan to them, that CBN told them that the amount of loan, the money that was going to the system, when they don't give enough loan. There was a time, I think it's under former the one with the go prison now. You know, I think there was a time they made that the number amount of 65% that it was given loan. You know, is it all those nonsense when they give? See, they crazy. Those who they crazy, I'm telling you. All those nonsense when they don't, you see how they punish them. It's the way they steal money. They know how to. No, let's not talk about that. Let's talk about ourselves. So anyway, the SAF ratio does not apply. Since I would do OBJ, that's why I bring all this on. They say cash reserve ratio apply to Microfinance Bank. Yes or no? No. Are you getting it? So that's why I'm bringing you this one. Cash reserve ratio for banks shall not apply to MLB. So, 2, capital adequacy ratio. Maintenance of capital adequacy ratio of what? 10%. Measure as percentage. This is how this measure. I've given you the formula there. Where we call capital adequacy ratio, the numerator, you have tier 1 and tier 2 capital. Talking about capital, there's equity and debt. Long-time debt. The borrowing, the facility available. So the capital that's available for you to run your institutions, the minimum you must have is 10%. We will do calculation all this later. So to qualify as tier 2, it was very long time under the source of capital. I think we'll be able to explain this better. I'll be able to explain this. There's a source of capital. That's why it's 7 years, because there are some that maybe are available for 1, 2 years, 3 years. They are not qualified under tier 2 capital that will be used for capital for this. Are you getting me? Yes. So that's why I put it there. I say tier 2. This thing don't they charge you? Jesus. This is not charging, man.
1,750.
Oh, why? Oh, yeah. All right. So I showed you the tier capital. So it must be any borrowing that's above 7 years. That's long-term borrowing. That's what we qualify for the calculation. So that's another prudential guideline. Capital adequacy ratio of what? 10%. And your shareholders fund that you are using must be done by losses. Liquidity ratio 20%. That's the minimum. So this 20% of liquidity ratio, 5% of net treasury bills is included. Look it. Oh. So included, you can see that it's far below the microfinance commercial bank. Limit of investment in fixed assets. Maximum amount of an MFB invest in assets is what? 20% of their shareholders' fund unimpaired by losses. Any contravention shall attract a penalty not exceeding 2 million naira or suspension of the license. I don't know where this million, because this million where they put. Now the prayer, now they, I'm not sure whether they don't really do upset. It will be more than 2 million now. So what you are saying, you are not allowed to use your depositors fund to acquire assets. Then even the that you are investing on, I'm telling you that maximum amount that you must invest fixed assets, 20% of your share. So when you look at your shareholders fund is 1 billion, 20% of 1 billion. When you look at your asset costs, it should not be more than 20%. Are you getting me? Of that shareholders fund There must be fixed assets. You don't want to go and grab the property over there and be engage in estate management or property development and be raising your money and real estate and be doing money and raising. You understand? And you don't want to go and tie too much money and buying cars and all those things, and the directors are pushing in that we end up using the resource. That's what came out of the all those guys started microfinance bank in those days. I've forgotten this microfinance bank that started then. I remember that's how they started, because this commercial bank mentality, all those guys that started, that's how they were, because they started having properties up and down. Even some of this in Lagos, because I work my former bank, my entity is the owner of the guy has to the change. All these group loan when they talk. But CBN will come, I can sanction me, I will pay. Because the guy will get the money. In less than 1 year, we break through. Because we are using the money, we are using the guy use the license to finance. I didn't talk about him. But don't mind me. The valuation of fixed assets. It's talking about CBN approval needed, permissible only after minimum of 5 years after acquisition. You need CBN approval for you to do evaluation of your assets. And before you can do the evaluation of your assets, it must be above 5 years that asset has been in existence. Are we together? And it's applicable to own premises. And when you do that revaluation, the difference that you find, you can only adopt only 55% of that difference. Then if it is above 90 days, how many percent? 100% provision. But that is the one for us. 100% provision for any loan that is due and it's not paid. Principal, interest, and non paid. Then interest must be suspended. What you are talking about provision is supposed to have that amount you have provided you. You are not talking of interest. Too. Are we together? You give 5 million naira loan. Is that 5 million naira you provide for? It's not the interest aspect we are talking about. That interest aspect must go to suspense. Hello? Shareholders fund to credit. You are saying, as MFB expected maintain a minimum of 1 to 10 between shareholders fund unimpaired by losses to net credit. 20 million. And your shareholders fund is 20 million. Your credit loan, you cannot have having 20 and 2 billion, 3 billion in loan. Why shareholders? So your shareholders must be commensurate 1 to 10. And we expect to maintain a minimum. So contingent items, concepts, I don't tire. This one, I don't tire. Eh? A grandma know the well, fixed assets, long-term investment. No MFB shall be allowed to finance any of the following other than from their shareholders fund. Okay, I think I've said this one before. I've said this one up there. I think all these ones that I do, but I have to delete them. Maintenance of statutory reserve. Yes, let me say this. Maintenance of statutory reserve. All MFB must transfer to reserve. When you make profits, before you share your profits, the profit you make in the year, there's a statutory reserve. Now, 50% of your net profit after tax, the balance in your statutory reserve account is less than 50% of the payout capital. There's a account called statutory reserve. Your payout capital, let's say that you have 100 million in your payout capital, and your statutory compulsory statutory reserve of CBN, you don't have up to 50 million there. When you make profit for that year, you must transfer 50% of that profit. I'm saying, sorry, 50% of the rate of profits must be transferred to that reserve. If you're this thing, so 50% of the profit you make, let's say, I'm saying 100 million in your capital, your statutory reserve, you have less than 50 million. On your profit, you make maybe you make 30 million naira profit. 15 million was transfer your statutory reserve. Are we getting me? You must be added to your statutory reserve because what your statutory reserve is less than 50% of the capital, payout capital. Are you getting it? That's the profit. So as long as you are still under 50% of payout capital, you must transfer 50% for any profit you make every year. You statutory reserve. But now, if your statutory reserve has reached up to 50%, above 50%, but less than 100, are you getting me? You will transfer 25% of that net profit. Am I communicating? If it is less than 50% of this of the net capital of the capital, you transfer 50% of the profit made to statutory reserve. But if it is above 50% or less than 100%, you will transfer 25. But if it is 100 million, or it's already 120 million compared to only transfer 12.5%. Yes.
Yeah, we now share the rest.
So where? You profit share. Shareholders don't forget their money. They go do profit sharing. No. So we are just talking about how much money transfer. It's a statutory reserve. It's a compulsory reserve. You must have reserve. Are you getting it? So I think that's it. Now, note this. When any of the capital adequacy or reserve ratio requirement fall below the prescribed level, the MMB shall be prohibited from any of the following until the required ratio is restored. You'll be prohibited from granting credits or undertaking further investment, pay dividend to shareholders, borrow from investing, or open branches. When you don't meet up to 10% capital adequacy ratio, you'll be presented. Your statutory, you don't meet up with statutory reserve, you'll be perfected. I mean, this is what we are talking about. When any of the capital adequacy or reserve ratios requirement fall below prescribed level, if you don't allow you to go ahead and just be granting credit anyhow. I mean, so this policy. And aside from that, if you meet below, you'll be CBI will guide you. You need to approval. You are under their guide because you don't give red light with that. So something is switching somewhere. All right. I think that's it. Let me stop here. I beg. It's not tired. I've not discussed today. I've not discussed capital. Maybe next time we'll talk about capital and business planning and all that. Next time. So, who is the class rep? So I will send the material to Michelle. Michelle will send it to us. All right.